what happened with inflation in the past 2.5 to 3 years is that during the past decade, the Fed operated under this model that inflation is very low, below their target, and they were very dovish throughout the decade. And this is because a theory that they were working off of for many, many decades called the Phillips curve failed on them. The Phillips curve basically tells you that at some point, around 4.5% unemployment, you start to see a wage spiral, and that basically is unhealthy. There's the labor market is too tight, and corporate profits erode, and you have inflation, and it's obviously going to cause tightening, et cetera, et cetera. When that did happen, when we got to 4.5% unemployment in 2017 and 2018 in the Trump administration, then they changed their stance. They became more confident that interest rates can stay lower for longer because, hey, everyone that wants to participate in this economy can participate. There's very low unemployment. It all looked very good. And when they entered the handling of the shutdowns, when they needed to basically bridge that income gap of $5 trillion for people that went on, were fired or otherwise, their system is the same, right? They're going to create some sort of a very accommodative interest rate policy. They slashed it to zero with an emergency meeting. They promised that they'll buy the junk bonds, and that really created a lot of confidence in the market. Then the government came in with the COVID, stimulus checks. So all of that was on trying to help the credit and the income side. What they all failed, but especially the government, because the Fed has very little to do with this. What they all failed to think about was, okay, how will this economy function with everyone at home and everyone having money to spend because you just gave the money to spend? Are they all going to just buy a lot of imported goods because they can't use the service economy? They can't go to a masseuse parlor or to get an experience done. They all have to buy appliances and furniture for the house, etc., etc. They missed that whole narrative, that whole behavioral change that the American public plus everyone else around the world, it wasn't just in America, they missed that whole thing. And when you have a country where two ports handle 40% of the import that come into the country, with Long Beach and Los Angeles, I mean, you create a very big problem. And they just did not handle it creatively at all. You didn't see any regulatory change, any incentives for the ports, any easing in legislation, any idea on how to work the shortages in trucking and in forklift workers and everything else. I think that that was the discoordination between the Fed and the government. The Fed in 2021 understood that there's an inflationary problem. They just called it a transitory problem because in their minds, they thought, okay, the free markets plus the government are going to work this supply side out. They're going to help with alleviating these supply chain shortages. And they just didn't. And throughout the year, the Fed just kept stalling. It didn't raise interest rate, it didn't lower interest rate, it did nothing. In November, after the Delta variant created even more inflation in August and in September, it could not keep saying that it's transitory because it became something that the word transitory didn't mean anything anymore. You can say something is transitory for years, but at some point there's real damage to the economy, even if something is transitory. And so they came out and they said right after the renomination of Powell that transitory is no longer the proper word for it. That really, they've ended the 13-year bull market that started in March 2009. It also ended the whole narrative that went along with that bull market. The narrative was low inflation, slow growth, and a lot of focus on growth companies because those companies can grow much faster than GDP, much faster than inflation. And that obviously was that whole FANG complex. And then in January, you saw the FANG complex literally collapse. You saw Facebook collapse. You saw Netflix collapse. Recently, you've seen Google and Microsoft go down 20% in 1 month in April. Basically, it's just Apple that I'm sorry, did I say Apple? I meant Google and Microsoft.
Right.
Only Apple has relatively held this whole thing up. And I remind you, Apple is the most dominant component of the Dow Jones. That's why the Dow Jones is the only major index not to go into a severe correction yet. So this entire thing has changed. The TINA, meaning there is no alternative, TINA is dead because the 10-year bond is yielding 3%. The dividend yield of the S&P 500 is way lower. So TINA, which means there is no alternative because interest rates are basically zero, is dead. Goldilocks economy, which is what people loved under Trump, that's dead. The FANG complex, that's dead. Hiring a lot of workers in Silicon Valley in order to create a company that has no plan on when to become profitable, but has a plan on how to grow revenues each and every year while taking a loss, that's dead. It literally is dead. You had one of the poster childs of that era, Uber, with their CEO saying literally yesterday on the call, he said it's time to stop focusing on growth and start focusing on bottom line. I tell you that because focusing on the bottom line instead of on growth means far less hiring. You cannot grow revenues and stay at a loss. That requires a lot of new people added onto the business. That's going away. That's a big shift. So in terms of the free markets, they've already changed. The damage, or I should say just the new era is already here. You're already living in a very different world. And 2022 is basically a washout of that previous narrative. The government basically failed at keeping us on that same narrative, if you will. The Biden administration has totally failed. It had one card, the Build Back Better plan, and they didn't do anything with it. And that failure caused also the Fed to be very late, and now they have to be way more aggressive than they would like to. And the market is basically there to adjust between the government and the Fed, because they now understand that they both operate very differently and not aligned as we've seen in the past 10 years. So that's what you're seeing right now. You're seeing a whole shakeout on Wall Street, and obviously being that this is the worst year for the stock market since 1939, the worst January till mid-May since 1939, and the worst year for bonds because bonds go down as yields go up. The price of a bond goes down as yields go up. This is the worst year for bonds since 1920, so in 102 years. This is really putting pressure on the wealth effect because Americans have lost, on paper, $25 trillion in the past 5 months. And what that means is that way more people are going to choose not to retire this year. If they thought about doing that, a $1 million retirement nest egg has just turned into $850 or $800,000. So you've lost a lot of real money. You have to stay a few more years at your job. You're seeing way more people that need to come back to the workforce because they can't live off of their equities anymore. Maybe one or the spouse, the husband or the wife were already retired or semi-retired. Now they have to go back to work. There's a lot of dynamics that are happening because of the loss in wealth effect. The next tier here, after the wealth effect, is real estate. Real estate is becoming very unaffordable to many Americans, with mortgage rates going to 12-year highs at a market where the prices are very high. That is a lethal combination. So you're going to see more slowdown in real estate as well.
Do you see a real estate crash? Because if the rates continue to move up and the prices move up at the same time, it kicks a lot of people out of the market. Aren't there going to be a lot of houses just sitting there?
There is a shortage of houses. There literally is a shortage in housing across America. There's about 2 million homes that are still missing to meet with the demand. What I think you're going to see is some sort of a freezing in prices, and you might see pockets here and there of real crisis, but not something like 2008 or something like that. Not at all. It's a very different market in America. The people that now own homes, they're not upside down at all. Their credit scores are way better than. It's just not the same problem at all. We do not have that problem that we had in that decade. What I'm more talking about is just that a lot less people will be able to afford to purchase homes, and that mortgages are going to be way more normalized and not at the historic lows. This whole thing is this new economy, this new era that we're getting into, and it's very different than what we've seen in the past decade. So to answer your question on whether or not they're going to lower, they're going to be able to lower inflation back to that target 2%, I'm going to tell you, I may be the first one to tell you this, but I think they're going to move the target to 3%. I think they're going to change what they think about as neutral, because to take it down from 8, where it is right now, the CPI. Obviously, you and I off the air, we discussed the prices, and we both think it's double digits, but for CPI, for what the barometer for Wall Street and everyone else for what they work with, when you have CPI at 8, to lower it to 2. You're talking about something that could take years to do. So I almost think you need to think about it like that spurt that took us to 8%, that boom in inflation is something that's very hard to put back in the box once it's out. You cannot do it without creating a recession that easily. And the Fed does not want to create a recession. If it wanted to, it would raise rates to 8%. That's how 100% you would kill inflation, but you would also kill the economy. So they don't want to do what Paul Volcker did. The Fed's strategy in 2022 and throughout the past decade is to communicate what they want to do so much in advance that it starts to work its way into the market even before they've done something. I'll give you an analogy. Let's say you're playing for a basketball team, and your coach tells you whoever doesn't run the 100-meter relay at less than 10 seconds will not play this season. And we're going to test this on August 1st. Well, you're not going to wait until August 1st to start training. You're going to start training now because you're not going to be ready for August 1st. And that's how the Fed works. It tells you what it wants to do, and the market already prices it in to the degree that it believes that the Fed will actually follow through on what they say. So when Powell said we're going to have 3 rate hikes in 2022, the market did not believe it at first at all. Then the market believed that it would do way more. And you had JP Morgan come in with 7 rate hikes. You had Goldman Sachs coming with 9 rate hikes. And when I say rate hikes, I mean 0.25%. So basically, they both were saying interest rates are going to go, the Fed fund rates is going to go to around 2%. Now the market believes that the Fed has done a lot already, even though it's only 0.75%. And we do have a 100% guarantee that in June they're going to raise rates by another 0.5% to 125. The market believes that that's a lot because, as I said, the wealth effect has been totally decimated. Think about all the people that would have gone on vacations this summer, would have bought a new car, and all that is gone because of what's happening in the stock market and the real estate market. Think about all the CEOs that are not going to hire because the shareholders told them, I don't want you to lose any more on the bottom line. I want you to start making money on the bottom line. So start thinking profitability and not growth. This is a whole new order of the economy in the United States. And then you couple that with this, black swan event that happened 11 weeks ago, where Putin went into a special operation in the Ukraine. So, and also, I don't think anybody foresaw that China would be this strict with its ports in 2022 when the rest of the world is literally opened up already. So all of that tells me that this decade is going to be far more inflationary than anyone would have thought a year ago, and that to lower inflation to where you're neutral and the economy is healthy, that's going to take a while. And for them to do it without creating a recession, it's going to require a lot of delicacy. And I think throughout all this period, the markets are not going to like it. Real estate is going to be more fragile. It's sort of a withdrawal period from the previous narrative that we had between 2009 and 2020, basically until the shutdowns, and this new economy that we've entered right now. So way higher inflation than before. I think that also, and I'm sorry for being long, but I'm kind of wrapping a lot of ideas here. The pain that people have suffered now with tech companies, that's also going to change their mind about tech. Tech is now vulnerable. Tech is now fragile. Buying Netflix is not a no-brainer. Buying Facebook shares is not a no-brainer. Buying Nvidia shares is not a no-brainer. Buying AMD shares is not a no-brainer anymore. These are all fragile corporations now, and that's something to keep in mind as well. That is very reminiscent of the early 2000s, where people were afraid and cautious about tech for many, many years. So that is something new that we haven't seen in a lot of years, where people are afraid of tech. And crypto is very correlated to tech now. So crypto is vulnerable. I mean, gold is one of the best performing asset classes in 2022. So, and commodities in general. So the world is really changing. It's really changing. If you look at the way we work, the way we hire, the way we value stocks, the way we value real estate, the way we value bonds. It's all changing tremendously, and it's almost like a boxing match where you see this guy who doesn't want to give up. He's taken a lot of hits and always gets up. But after a while, it's too much. Like he can get up, but it's pointless. It's useless. He needs to rest and come back another day. And that's what's happening right now. the world's economy has taken so many punches in the last 2 years that it needs a rest and it needs to reset and morph into its new entity and proceed. I think America has an incredible decade ahead of itself. The demographics look amazing. It's very healthy. The economy looks very healthy in general. But you need to fix this problem. You cannot have an economy with 11 million job openings and 6 million job applicants. It's unbelievable. You cannot have twice the jobs as there are applicants. And this is before even looking at, are these applicants even skilled in the jobs that are open? So all of these things are a product or a byproduct or a result, I would say, of what happened in the past 2 years. So it's a very difficult time. It's 100% a difficult time, and I think that's why Putin took the decision to basically to do what he did now, because it's all confused around the globe. Mm-hmm. And I think he saw that, he sniffed that Biden is a transitory president, to be honest. And just like a lot of other prime ministers in the past, when you see that there's a transitory period in a country that has leverage on you, you capitalize on that. So a lot of issues, and then you obviously China is the one that I didn't talk about here, but it can do a lot of damage as well if it wants to the dollar standard and also to Taiwan, and that's the big elephant in the room. I also want to tell you, Dave,
sure,
that I put together a report about like all of this and more that talks about 2022 and talks about these catalysts. If you go to wealthresearchgroup.com/2022, so 2022, the year, you can see the full scope of the economic outlook for this year. We put this research together after looking at services that cost us thousands of dollars to access from accredited investors. It has a lot of charts. It's very detailed. And then we also did one just for your show just recently. That's wealthresearchgroup.com/11, 11, that is. And that's 11 catalysts that we believe are going to be what catapults gold to $2,582 an ounce before this rate hike period is over. So basically in the next 18 months here, we see a huge move for gold.
So, I mean, since you're mentioning gold right now, why do you think gold is dropping? I mean, let's talk about being prepared. Friends, the world is in serious danger now. Inflation is causing food prices to skyrocket. The global supply chain continues to collapse. And then the coming food shortages will be worse than anything we've lived through. In times like these, what should you do? Go to preparewithx22.com and invest in long-term emergency food storage from My Patriot Supply while you still can. My Patriot Supply is the largest preparedness company in America with millions of satisfied customers. Their food lasts for up to 25 years in storage. When you need it, you'll have it, and avoid government food lines. Act quickly and save $150 on a vital 3-month emergency food kit. This kit provides a variety of delicious foods totaling over 2,000 calories a day. You won't go hungry when you have this emergency food, period. Go to preparewithx22.com and save $150 on every 3-month food kit. That's preparewithx22.com. Protect your family and secure this emergency food today. Go to preparewithx22.com or click the link in the description. Over $2,000 an ounce. And now, as we're seeing inflation, as we're seeing higher fuel costs, we're seeing gold move down. What's your take on that?
There is a lot of margin call activity right now. There's a lot of margin call drama. And when you have 2 or 3 or 4% of your portfolio in precious metals, mm-hmm. And you're getting a margin call, a lot of the times you're going to fund that with precious metals. I think that's one reason we're seeing gold down. A second reason is because a 75 basis point hike in June is not off the table, in my opinion. So you have that, even though the Fed said it's off the table. Like literally, Jerome Powell said we will not raise rates by 75 basis points. the market clearly doesn't believe it. The market still believes it can get aggressive. I think that's the second reason that that gold is like floundering here. And also, there is a thesis brewing out there on Wall Street that we might have seen peak CPI. In other words, that the next CPI reports will be high, but they will not be higher than before. We've peaked in CPI data. So keep in mind, like CPI, you track month over month and year over year. So for CPI to continue at an 8% clip, it basically means that it's 8% higher than last May, and then 8% higher than last June, etc. A lot of this CPI, because it doesn't have anything to do with energy and food, a lot of that CPI had to do with the chip shortages and used cars and whatnot, and those have started to, and freight costs, those have started to correct because everything's opened up. So that thesis is also working itself out, that inflation has already peaked. So keep that in mind. The way that gold starts to rally again is when the Fed starts to say we've turned a corner on inflation. So it's actually when they say that they've started to beat inflation that gold will start to go up. Because if they say that, that alleviates the fear of a recession. It alleviates the fear of interest rates going to, much, much higher and way more aggressive, which is counterproductive to gold. And that is actually what's going to help gold. When the Fed starts to say that they've got this thing under control and that they don't need to be as aggressive as before, when they start to do that dovish pivot, that's when gold will start to move again. I remind you, in 2015, the last rate hike cycle, they raised rates in December 2015 and waited for a whole year until December 2016 with their next rate hike. And during that 2016 season, gold moved up by 30%. So in 1 year. So the markets like it when the Fed raises rates. When I say the markets, I mean gold bulls like it when the Fed raises rates, but not aggressively. That way, the rates do not change the equation of negative interest rates. So in this scenario, if they start to claim victory over inflation, that's going to be really good for precious metals. Keep also in mind that the dollar right now, because everyone is selling bonds and stocks and settling their transactions in dollars, the dollar is at a 20-year high compared to other fiat currencies. We have to go back to 9/11 for the dollar to be this strong on a global basis. A strong dollar, when you have oil at 100, is very unique. Once the risk-on environment returns and people move back out of cash and into equities and real estate and bonds and whatever they decide to do with their funds, you will see people, selling their dollars, and that will start to work itself out into the price of gold and silver, specifically silver, which much more correlates with dollar weakness or dollar strength. So you have that playing out as well right now. I think all of these are critical for understanding what's going on. And I would say that if you look at this from a bird's eye view, you will understand that gold is in a very good position to move into all-time highs as they start to pivot. When will this pivot be? They would obviously love to get all the hard work done by June. So another 50 basis points will come in June, and then they'll want to move into the background as we move into the midterms. They don't want to be a political problem for either side. They don't want any finger pointing at them. They want the Democrats to point fingers at the Republicans and the other way around. So I think during that second half of the year, they'll be much more dovish. They'll take their time, and they won't be as aggressive. I think that couple that with what you're already seeing. I mean, 20 minutes before we started this interview, with Biden, saying, "Hey, we got to deal with this inflation." Blah, blah. These are all campaign promises that you're going to start seeing, and these promises, that's actually what we need. We need them to start tackling inflation because the government can do a lot of things that the Fed just has no ability to do. It's not in their legal right to do a lot of things that the government can absolutely do to help with alleviating supply chain shortages, supply chain constraints, and whatnot. So I think that's all positive. We're baking in a lot of the negative into this first part of the year, and during the second half, we're going to see a lot more of the good side. I personally do not think that we're headed to a recession in America.
That's what I was going to ask you, because there's a lot of individuals, a lot of economists, financial pundits, even like Kashkari, the head of Minneapolis Fed head there, they're talking about a recession. So they're saying, yes, if this continues on like this, we'll be heading into a recession. Now, we saw back during many times during when we had recessions, the Fed raised rates and they hit a certain point, and all of a sudden the economy started to fall apart. People didn't really notice it, and then they started to drop rates. But, a couple years later, the economy fell apart. What happens if we head into a recession? What happens to gold? What happens then? So
my base case is that the economy is not going into a recession, but the Fed has to really, really mess this up. And what Kashkari said a day ago on Squawk Box, if you're referring to that, is he was saying, look, we're doing all the heavy lifting. The government is not. He obviously said it way more diplomatically than what I'm telling you, but he basically said, look, we're doing everything. We're raising rates. We're tightening. We're selling the balance sheet. We would love for Congress to start doing things. Like we would love for Congress to help with the ports working 24/7, hiring more truckers. There's all sorts of tax incentives and other sorts of legislation, regulation, working with municipalities, all these things that they can do to help. America has 2,000 ports. There's no need for 40% of all the ships to go into 2 ports out of 2,000. That's insane. So there's a lot of things that can be done to fix what's going on. But if the Fed has to do all of it, then yeah. That is the scenario in which the Fed tightens into a recession. I personally do not think that will happen because they speak that problem to the world, and basically a lot of CEOs, a lot of small, medium, and big businesses can already start to prepare for this. So this open dialogue between the Fed and the participants in the economy is very healthy. This was not the case with Volcker. Like when Volcker did this, he did it and announced it the same day. It's not something we do today. We don't raise rates and then tell the world about it that same day. We have the dot plot, which is basically how all of these governors at the Fed think about raising rates. So you have literally their plans a year or two in advance, and that's very helpful. So and I also told you about the labor market and how strong that is, with almost double the job openings than there are people that want to get jobs. Real estate is still very strong, and I call my fund managers for real estate once a week to ask them, like, are you seeing any panic? Are you seeing any slowdown? Are you seeing lots selling for cheaper? Are you seeing liquidation sales? Are you seeing big institutional funds backing away from large deals? What are you seeing? And they're saying that everything looks okay in many states. So to me, the base case is not a recession. If you have a recession, a lot has already been priced in the markets and everywhere else. I think that where you don't see a recession priced in is in energy prices, obviously, right? Oil would not be $100 if there's a recession coming, and you don't see it in real estate prices. So I would say if there's a recession, you'll see, first of all, commodities go down, and you will see real estate slow down significantly. And gold would not be, an outlier. It would not rally while everything else.
The only reason I say this is because Biden's agenda and Obama, who's in the basement, speaking to him through an earpiece, their agenda and the World Economic Forum, their agenda is to bring us into green energy. And they're trying to push everyone into green energy. So they want the fuel cost to go up. They want all of this to happen. And if we start shifting this entire system into what they want, they're not going to do anything to try to stop any of this. You see what I'm saying?
Yes.
So they're just going to sit back and go, okay, you know what? Yeah, fuel costs are going up. I mean, put it this way. Biden could have stopped this from the beginning. What did he do to the Keystone Pipeline? What did he do to the lease agreements? He actually kind of caused this. Actually, if you go back from the time he came into office, right before the Ukraine operation, fuel costs were going up because he canceled the Keystone XL pipeline, reneged on the leases. He put into place regulations. Actually, this country, America, was energy independent before this. So this never had to happen. He actually caused this, and their main agenda right now is to bring us into something completely different, where we have windmills, we have solar panels, and we don't have fossil fuels. Well, maybe for them, but not for everyday people. So I don't see him helping. Yes, he talks a lot. Yes, he's going to say he's going to tackle inflation and fuel costs and use the strategic petroleum reserves to try to make it look like things are happening. But I don't see them actually tackling this at all. I see them doing the opposite.
There's a lot of distrust between oil executives and the administration. Yeah. And that's the big problem. When you ask the execs from any of the large oil companies that operate some of the most important energy projects in America, they all tell you, we are holding back. This is not Trump. This is a very hostile environment for us. There, a guy from the environmental agency can come here after we've spent 40, 50, 100, 150 million and start slapping us with fines for this and that. And if you listen to their earnings calls, they all tell you we can ramp up as long as we had the government in our backs. We would produce more, we would do more, we would this and that. This pipe dream of changing to green energy in the flick of a finger, it's just not real. And so what they're doing is very counterproductive. So if this is on purpose, then they're succeeding, because it's deterring these energy companies that can literally turn on the spigots way more from doing so. They're very afraid. They're getting slapped left and right by these fines, endless fines, and reclamation costs and whatnot, and it's just endless. So that environment is just not pro-business. So that's something we're seeing with this energy complex, and I don't see that changing under this administration. Obviously, if we had Republicans in office, this would be much more relaxed, right? You would not have.
You would hope so.
Such a you would not have the same environment. I mean, Trump talked about getting coal jobs back. So coal being one of the dirtiest of all forms of energy. So obviously he wasn't as concerned about ESG as this government is, and climate change and whatnot. This government is very concerned with climate change, or whatever you want to call that. and you're seeing that they're even asking the Fed what it can do about climate change. I mean, a bank, like what can a bank do?
Right.
I don't, it's sometimes comical what what Congress asks Jerome Powell. I don't think he even knows like what to answer when they ask them stuff like that. So I think they're trying to hint that the Fed will constrain loans to oil companies, but they will never ever do such a foolish thing as refuse a loan to an oil company just because it's an oil company. So, to kind of finish my reply to your remark, I think that America's energy industry could be way more independent than it already is, had it had the administration at its back. And I think that there's other industries that we can say the same about. Obviously, the polls are showing that Biden's popularity is super low. And it will come down to whether or not America is ready to accept Trump again or not. So that's, I think, the big question. Is the majority of Americans ready to accept him? And because the country is basically divided in half. So it's going to come down to the wire again. And we shall see. But we're a long ways away. Like we need to really see the economy staving off this period of higher inflation, because it's hurting everyone. The food prices and the energy prices are hurting the I would say 200 out of the 330 million Americans. That higher food prices and energy costs and rents really change their lives. It really makes them change behavior. And I would say the top 130, they're feeling the burn in terms of how their retirement and their wages, their stock portfolios, all that is hurting them. So everyone's hurting. Like this is a real problem. And the question that the Fed has to simply ask itself is how to solve it with the least amount of pain, because the pain will definitely be there. You cannot avoid the pain of trying to get inflation back down without having collateral damage. And they say so themselves. They say that their ability is to influence your behavior by weakening your demand for things, demand for real estate, demand for purchases, demand for everything, because they make credit more expensive. And we live in a credit-based society and government.
And let me just ask you this about food, because here we're seeing a baby formula shortage here in America. We also had Biden come out and saying, yeah, there's going to be problems with food. Do you see this playing into all of this, where food shortages are going to be a huge problem?
Not in America. Not in America. I heard about the baby formula shortage, and it's definitely concerning, obviously, but in a general sense, I think that you're just going to have higher food prices, but the food shortage is way more realistic to see in second world countries, countries where the average daily pay is between 30 and 40 and $50. So that puts a lot of the world's countries into it. And obviously, third world countries are going to see that, because what's happening in Russia and the Ukraine is creating a fertilizer problem. It is a problem. Like there could be countries where you do see riots, where you do see that if somebody needs to pay 50% of their income on food, I mean that's a problem. In America, it's around 12%, so it's a different world. I think that you'll see these riots if the war in Ukraine continues, and if China continues to have these zero COVID policies on their major ports. You will see problems like that, but I don't think they'll arrive in the United States.
Hey, Lior, thank you very much for being on the X22 Report Spotlight. Once again, how can people see all your work?
Wealthresearchgroup.com is the website where you can sign up for the newsletter. Mm-hmm. With regards to the war in Russia and whatnot, we put together a couple of very important reports on what's going on. And they can be found at wealthresearchgroup.com/Putin and /Russia. That's kind of our take on what's going on over there.